Okay, we're just getting ready to get started here. So again, bear with us. I apologize for the slight delay. We're trying some new technology here. We're actually broadcasting this webinar to Facebook, Twitter, and a few others. So again, bear with us. I apologize for the slight delay. We're trying some new technology. And I apologize for the echo. We're still learning here. So anyways, we're going to go ahead and get started. Today we're going to talk about day trading with weekly options. And if you're not familiar with weekly options, then you're in the right spot. We're going to tell you all about them. By the way, we are DeCarley Trading. We're located in Las Vegas, Nevada. We are a futures and options brokerage service. So if you're looking for a good futures and options broker, hopefully we can fit the bill. My name is Carly Garner. I am a broker and an analyst and a couple other things. I wear quite a few hats at DeCarley Trading. If you have any questions or comments or concerns about anything that we talk about today, feel free to give us a call or send us an email. Here's all my contact information. We also have a presence on social media, so if you're interested, we do post charts, commentary, pictures of my dog, that sort of thing on social media. So we hope to see you there. Just a little background if you're not familiar with me. I am a broker, a strategist, and an author. I do provide content to Jim Cramer's Mad Money roughly once a month, sometimes more, sometimes less, regarding commodity market, chart analysis, that sort of thing. I also write a column for Stocks and Commodities magazine, and I do write a couple of newsletters exclusively for DeCarley Trading clients that include market commentary, trading ideas, that sort of thing. If you haven't already signed up for a free trial, you can do that on our website, DeCarleyTrading.com. And last but not least, I've written about 4 books. Some of these books I've written multiple times. You know, things change quickly in this business, and so it's necessary to update them frequently. So if you're interested in learning from ground zero, A Trader's First Book on Commodities is intended to teach you everything that you need to know before you actually place a trade. And higher probability commodity trading is intended to help you along the way in regards to strategy development, market analysis, that sort of thing. We talk a lot about option trading and higher probability commodity trading. More importantly, option selling or using options to hedge futures positions. Before we get started, I just want to make sure everybody realizes that we're here to speculate. There's a substantial risk of loss in trading futures and options. There are no guarantees that anybody's going to make money. In fact, it's you know, trading is not suitable for everybody. There's quite a bit of risk involved, and so I want to make sure everybody understands that before we go on. Okay, well, first let's just talk about day trading itself. Should you? Day trading is not for everybody, but it does attract a lot of traders because traders are, quite frankly, they're drawn to the idea of low barriers to entry. You know, you've probably seen the ads. A lot of discount brokers advertise $500 margins to day trade the E-mini S&P. I, for one, am not a fan of that kind of margin usage. That's just too much leverage. The odds of making money when you're using that much leverage is extremely thin, but you know, it is available for those that want to do that sort of thing. And it is attractive. The idea of trading a couple $100,000 worth of the S&P with $500 in your account seems exciting. Unfortunately, I live in Las Vegas. I know how gambling works, and day trading the E-mini with $500 is nothing more than gambling. You might as well go down to the casino and play the tables. Probably have a little better shot. Day traders love the idea of no overnight risk. You can sleep at night, regardless of what happens in China or Europe while you're in bed. You don't have any risk on the table, so that's the nice thing about day trading. But really, most people are attracted to day trading because it's exciting. The profits and losses are sped up. Most day traders are using the same chart analysis that position traders use on a daily or weekly chart. So it's the same type of analysis, same strategy, just everything is supercharged because it's in short time frames. So day traders probably stand to make or lose money faster than position traders. It's quite a bit more volatile, which to some is attractive. The downfall of day trading is almost exactly what's also attractive about it. The flashing lights, the quick fills, the adrenaline, a lot of times it gets the best of traders. It's not everybody can day trade. It takes a special kind of human to do it, just like not everyone can be a doctor or a first responder. Only certain people can day trade and actually make money doing it. It's not easy. Day trading magnifies the exposure to destructive temptations and obstacles, such as overtrading, over-leveraging, emotional decision-making, and economic announcement volatility if you're trying to day trade on or during the non-payrolls or Fed announcement. Good luck. So one of the biggest downfalls of day trading is, in addition to some of the other things we've already mentioned, is stop orders. I know that most books you read will tell you always use stops, never trade without stops, so on and so forth. The idea is stop loss orders are meant to protect traders from large losses, but you have to keep in mind that if you're placing a stop loss too close to the market and you're simply getting in and then getting stopped out right away, those small losses add up really quickly. I actually believe that stop orders in many circumstances do more harm than good, and I know that's contrary to what most people believe. But unfortunately, it's Murphy's Law. The odds are a lot of traders, and very frequently, are going to be stopped out before the market moves in the intended direction. And this happens even traders that are using very deep stops and giving the market plenty of room to run. Every once in a while, you'll see the market stop everybody out and then move on without them, and that's very frustrating. And on top of the fact that you were stopped out of a trade prematurely, you lost money, you're watching the market move the way you wanted it to move without you, it becomes a big emotional game. I mean, that really plays with your head, and then you end up, when I say you, I'm just speaking in general, traders have a tendency to make poor decisions after being stopped out. It's a mental game. I happen to believe that long weekly options eliminate all of these risks, or at least mitigate it. And we're going to go through some examples. I'm hearing some people that are having some audio problems. I'm going to mute the conversation for just a second. I'll be right back. Okay, let's try this again. Hopefully this is a little clearer. I apologize if there was any static in the line. I don't believe it was on our end, but we reset everything and we hope that it gets better from there. All right, so as we were mentioning, day trading is a mental game. sums up the difference between making money or losing money pretty efficiently. Nothing gives one person so much of an advantage over another person as to always remain cool and unruffled under all circumstances. Those that keep a head on their shoulders are the ones that eventually have a much better chance to make money. It sounds very simple, but it's a lot easier said than done. But I do think that using options, as we'll talk about today, will mitigate the emotions enough to put you on the right side of that column. So we all know about trader psychology, whether you're day trading or position trading or whatever your strategy is, all of these things come into play. It comes down to fear, greed, and frustration and how you deal with those emotions. We've all been there. We've all suffered from them. We've all learned lessons from them. Unfortunately, that's part of the game. What we're going to teach you today is hopefully a way to, you're not going to avoid emotions in trading unless you're dead. Hopefully that's not the case. But you can mitigate it substantially by using options instead of futures to day trade. So to sum everything up, the two largest obstacles to successful day trading are premature stop outs and emotion. And again, to reiterate, the practice of buying short-dated option eliminates the risk of both of these things, or at least mitigates it. I shouldn't say eliminate, that's not the right word. So, okay, I'm gonna log out and log back in, and hopefully that'll fix some of the audio issues. I apologize. Okay, I have called in via an old-fashioned telephone, so hopefully that'll be better. Can everybody hear me? Okay, all right, let's give this a shot. My neck will probably be sore by the end of the day, but that's okay, it'll be worth it. All right, perfect. So I apologize for that. Let's get back into things. So in addition to mitigating the emotional turmoil and the risk of being stopped out prematurely, some additional obstacles solved by long option trading versus futures trading are there's no margin concerns. So if you're trading long options instead of futures as a day trader, you don't have to worry about holding overnight with full margin charge. You're not going to be forced out by the close. If you've ever day traded before, you know that a lot of the motivation to get out of a trade is, what time of day is it? I have to be out by the close. I don't have the margin to hold the position. That sort of conversation is going through people's heads. So if you're using options rather than futures, you don't have to worry about the fact that you're going to be charged full margin if you hold beyond the close, because your option is an option. The risk is limited. There is no margin. It's not going to impact your trading. I know a lot of day trading systems and day traders themselves, they get signals later in the day, but they're worried about taking them because they know they have to be flat by the close, or they might be in the middle of a trade that may or may not be working out, but the market hasn't developed, the trade hasn't developed, but yet they have to get out because they want to be out by the close and they don't want to be charged the full margin. So if you're using options, that is no longer a worry. You have lasting power. You can hang on overnight if you want to. You can hang on beyond the close, even if it's an hour or two beyond the close. You have the ability to do that without any additional consequences. Naturally, with the options, you're going to have more lasting power. You're less prone to panic. There's no stop loss necessary. You're always in the market. So I'm not saying you can't lose and the market can't go against you, but you're always in the market and you're always there you'll always be there if the market reverses for you. Somebody's asking about what about the time decay in long options, and yes, obviously that's a concern, and we will talk about that. Yes, and someone's asking, is option trading available overnight? It honestly depends on the brokerage firm you're working with, but we allow traders access to futures and options 24 hours a day. So the answer to that is yes, and actually I should take that back. It's 23 hours a day. The CME does pause trading for about an hour. Another great thing about using options rather than futures is there's no forced liquidations. The risk is limited. Again, there's no margin. The brokerage has no risk beyond what you paid for the options, neither do you. So you don't have to worry about the broker stepping in and liquidating you if something goes wrong. Okay, some of you might be asking, what exactly are weekly options? Prior to weekly options, ES traders, that's E-mini S&P traders, were accustomed to working with options that expired every month. You probably remember the third Friday of every month is when the monthly options expired. In fact, that's still true, but we don't really pay attention to it nearly as much as we used to, because now in the futures markets, there are options that expire every Friday. So it's no longer just the third Friday of the month, it's every single Friday there's options expiring. And the CME has actually added options that expire on Monday and Wednesday. So in the case of the E-mini S&P, there are liquid and tradable options expiring all 3 out of the 5 days of the week. Monday, Wednesday, Friday, there are options that expire. So the great thing about that is, as a day trader, you can buy you're going to be buying options that expire in a day or two. And expire in a two. If you asked me about trading weekly options several months ago, I probably told you that they probably aren't liquid enough to do this sort of thing. But liquidity is there now, and it's getting better every day. So is there enough liquidity? Yes, there is. Weekly options are quickly gaining in popularity, and they've actually become very liquid, highly liquid. The bid-ask spread on Friday, Monday, or Wednesday weekly options is generally a quarter of a tick or half a point. So we're talking $10 to $25. So the bid-ask spread's reasonable. It's not going to eat you up on a day trade. Whereas if you were trying to trade the monthly options as a day trade, it might have, because the monthly options don't move quite as quickly as the day or the weekly options, because they only have a couple days left on them and they're closer to the money and they're just a little more reactive to trade. The daily volume on the Friday weeklies is generally in the thousands of contracts. So most traders aren't going to have a hard time whatsoever getting in and out of whether you're trading 5 contracts, 1 contract, 100 contracts. There really shouldn't be that difficult for the market to absorb it. And there's market makers quoting these weekly options basically around the clock, 23 hours a day. Now, to be fully honest, there are, like during extreme volatility spikes, like we've been seeing the last couple of months, you will see the market makers step back, pull their bids and asks, and when that happens, when the market makers take their quotes away, the bid ask balloons really wide. But that's going to happen with all expirations, not just the weekly options. That happens with the monthly options. It happens in any market, and it's usually temporary. In the E-mini S&P, it's temporary. It's minutes, not hours. Even some of the big moves that we had in the last couple months, the market makers really, when they did pull their bids and asks, it was for a few minutes, and then they put them back when things, the pricing was reasonable. Somebody's asking why he should trade ES options rather than SPX options. There's a few reasons for that. For one, you get access 23 hours a day. Secondly, they tend to be a little quicker, a little more responsive because the E-mini S&P options are written on a leveraged futures contract. Also, you're going to be taxed at a, well, actually, I take that back. SPX options, I think, are taxed similarly than futures options, but I'm not a tax accountant. But futures options are taxed on a 40 blend, and they're generally easier to for it on your tax than the future markets. If you're usually report one number at the end of the end of the year, you're given a 1099 by your brokerage. You report that on your taxes. That's it. You don't have to list each individual trade. So I think there's just a lot more flexibility with the S&P options, futures, S&P futures options, but I mean, it's a personal choice. So day trading weekly options can be thought of as poor man's day trading. They come with limited risk and they come with lower risk. The reason they're lower risk is because the delta, which is the rate of change in the option price relative to the futures price, is much lower on an option than it is a futures. So for example, the delta on a futures contract is 1. If you're trading an at the money option, the delta is about 50%, meaning for every point that the futures moves, your option is moving a half a point. So just by nature, the option position is going to move slower than the futures position. Obviously, if you're on the right side of the trade, that's going to be a negative, but if you're on the wrong side of the trade, that's a positive. I think in the long run, we would find that it's better to slow things down. The slower things move, the less volatility in your trading account, the more likely you are to keep a level head in your trading decisions. So some of you might be asking, do weekly options move enough to matter? And the answer is yes, they can. Weekly options enable traders to buy either at the money options or near the money options or out of the money options, depending on how aggressive you want to get with it or conservative you want to get with it. To give you an idea, as we mentioned before, an at the money option has a delta of about 50%. Therefore, if the S&P futures moves 10 points, the option itself is probably going to move roughly about 5 points. It's not an exact science, but that gives you an idea. 5 points in the E-mini S&P is $250. So if you were right in the direction, you would make $250. If you were wrong, you would lose $250. Obviously, that's a lot slower than trading the futures outright. And don't forget, you have limited risk. So if you're completely wrong and the market goes against you sharply, your risk is limited, yet you're still going to be in the trade, even if your option loses almost all of its value really quickly because the market moves against you sharply. You're still in the trade. You're not stopped out. You're not on the sidelines. You're still in. It can always get better. So this is an example of what an option chain might look like. These are options that had, I think these options had 2 days to expiration, but to give you an idea, right, getting the highlighter out here. So the market, the S&P at this point was at 2833. You see the high of the day was 2837 and the low was 2809. So obviously that was a pretty decent trading day. There was some volatility there. But if you're doubting whether or not these options can move enough to day trade, doubt no more. And I'm granted, I am totally aware that recently the volatility has been a lot higher than it was during most of 2017, so that's absolutely true. However, normal volume is probably a little less than what we've been seeing lately, but a lot more than what we saw in 2017. So even if things do calm down a little bit, I still think there's going to be some opportunities here. And again, we're working with limited risk, and so I think there's, I still think it's worthwhile to take a look at. So let's assume that you were trading options somewhere here in the middle between the high and the low of the day, around 28.10. You'll see this option had a low of roughly $2, which is $100, and a high of $10, which is $500. So, I mean, obviously, you're probably not going to buy the low and sell the high, but if you catch something in the middle, that gives you an idea. A trader might have made 4 or 5 points, maybe 7, 8 points. So we're talking a total risk of $100 at one point could have possibly turned into a profit of 2, 3, 4, maybe even $500 if you're really, really lucky. So these things can move. There's plenty of profit without unlimited risk and really without a lot of risk. Obviously you have to be right. Now the key to this is these options will lose value very quickly. So if you are wrong and it does go against you, an option that you paid $100 or $200 for it could just go up in smoke pretty quickly. But again, how quickly can you lose a couple $100 in the futures? Probably even faster than that. Okay, so somebody's asking, other than Thinkorswim, which platforms or brokers permit option trading? The reality is a lot of brokers do not offer these weekly options, and the reason being, it's really easy for an experienced trader that's trading online to buy an option that expires tomorrow, to forget about it, or to just not understand how options work and be assigned the futures contract. So it's very easy for something to slip by the cracks if a newbie trader is trading and just doesn't understand option expiration and exercising and that sort of thing. So a lot of brokers actually do not allow their clients to trade these products. We do. We are a brokerage. Our platforms have the Monday, Wednesday, Friday options. Anything that's listed on the exchange, you could trade with us, and we're not going to restrict it. We're not going to tell you which expirations you can trade, which products you can trade, like a lot of other brokers do. So somebody is mentioning that SPX options are cash settled. In futures, they are not cash settled. You would be exercised into a futures contract. So you really, when you're doing this sort of thing, most of you would not want to hold it all the way to expiration, because if it is in the money, the exchange will automatically assign it. You will have a long or short futures contract from the strike price, and you probably don't want that. Someone's also asking what the multiplier is in the E-mini S&P. Each point is worth $50. So if you buy an option for $2, that's $100 that you paid. If you sell it for $10, that's $100. So each point is worth $50. So the math is quite a bit different than it is in the SPX. Now, with this type of strategy, you probably want to stick to the E-mini S&P for now. That's where the liquidity is. That's where you're going to get the most action. That said, weekly options are being added all the time, and they're becoming more liquid. You could probably sparingly, not something regularly, but you could probably do something similar to this in crude oil or the 10-year note, or maybe even the euro, but just be mindful that the liquidity is a little less and you have to be a little more careful. So one thing that turns people away from trading options rather than trading futures is the idea that it's not as simple. When you trade futures, if you go long and the market goes up, you make a little money, and you can easily calculate how much you're going to make or lose per point. Options are different. Options do not move like that. If you're talking about at expiration, you can calculate profit and loss. Mathematically, it's a black and white equation. If you're talking about before expiration, which is what we would be doing as a day trader of these options, it really cannot be, you really can't predict what the option is going to be worth, because It's based on time, volatility, and demand, and these things cannot be quantified. So we can make guesses, and we can make pretty good guesses, but we're not going to know exactly what our option is going to be worth if the S&P goes to X price. And unfortunately, that does turn some people off, but don't be scared by that. It's actually not quite as complicated as it sounds. Okay, so this is actually crude oil options with 7 days to expiration. Remember, I mentioned that we should probably focus on the E-mini S&P, but it is possible to do this sort of thing in a market like crude oil. There are weekly options. In this instance, we're talking about options that expire in a week. The market's trading at about $61 at this point. If we think that crude oil could drop $1 today, meaning we think it's going to 60, rather than selling a futures contract and then placing a stop and hoping for the best, we could go long a put. An example might be the 58 put, which is obviously quite a ways out of the money. But the idea is this 58 put is only worth 12 to 14 cents. So we're talking roughly $130 is how much it would cost us to buy that put. No matter what happens, no matter where crude goes, the most you could ever lose on it is $130 plus the transaction cost. But if crude does actually move, that option could pick up value pretty quick. So let's assume that crude does drop $1. As I mentioned before, we can't pinpoint exactly what that option is going to be worth, but we can take a guess by looking at the 59 strike. So we know the 59 strike is $1 higher, which means if crude drops $1 in a short amount of time, I'm not saying if it drops $1 tomorrow or the next day, because that's a whole different story, because then the option is losing time value. But if it drops $1 in the next couple of hours, it's fair to say this option is probably going to be worth 24 to 26 cents. So it probably would have doubled in value. I mean, obviously, if you want to get a little more aggressive, you could have gone with a 59 put and so on and so forth. A 59 put would cost you $250 roughly. If crude dropped $1, you could guess it might be worth somewhere around $500. So it would have doubled in value also. So you'd be risking $250 to make $250, that sort of thing. And again, these are guesses, but they're pretty good guesses. They usually work out exactly how we expect. When they don't work out is if you're trying to buy crude oil options right before the inventory report, or the move occurs several hours after you purchase the option, then at that point you're going to see the premium erode pretty quickly, and so you have to be aware of that. Let's take a look at a couple of examples. So these are E-mini S&P options with 2 days to expiration. A day trader might see a little trading pattern going on here, might get interested in selling a futures contract. Of course, if he sells a futures contract, he's immediately losing money. He has to either put a stop order in, run the risk of being caught in a way trade, and that's no fun either. So maybe a safer way to play it would be to buy a put option. Now, in this environment, when I put this example together, the market was very volatile. Options were really expensive. Normally, want to try to target an option with a strike right around 2,700, because it's feasible that if you're right and the market stays in that range, we could see the S&P come down to 2,700. In this case, the 2,700 put was be a little pricey, so this trader might have opted for the 2,680. The market never has to get to 2,680 for that option to increase in value. All that has to happen is the market turn around in a timely manner, and in a manner that's quick enough that the time value erosion doesn't eat up any benefit and price change. This particular trader could have bought this option for 2.65 points. So basically roughly 2.5 points, and that equates to $132.50. So again, that's the most you could ever lose, no matter what happens. If the S&P goes to 3,000, the most you're ever going to lose is $132.50. Okay, somebody's asking why not buy in the money options or at the money options, and you can absolutely do that. Obviously, they're more expensive, but if you want to get more aggressive with it, you absolutely could do it. I'm just giving you an example of how a very low risk and a risk averse trader could do it. But for sure, you could buy at the money. Like let's show you another example. These options have 2 days to expiration. The S&P is at 2730. Actually, I cut off the 2730s, but you could buy 2720 puts for about 500 bucks. So something like that would get you in a lot more active position. It would move a lot quicker relative to relative to the futures price. So for example, if you bought the 2720s and the market dropped 10 bucks, you're probably easily looking at somewhere around a $300 to $500 gain. Maybe not quite that much, 300 to 400, somewhere in there. But you get the idea. They'd be a lot more responsive. So if we're a conservative trader or somebody that's wanting to quasi paper trade, like paper trading, but have some skin in the game, might look to go for an option that's a little further out of the money. Another thing you could do is buy higher quantities. So if it's just not enough action for you to buy an option that's out of the money and is only going to move a couple $100 a day, buy 2 or 3 or 4 or 10 of them, whatever it is that you want to do, or get closer to the money. So I'm just trying to show you some examples of how they might move relative to the futures market. All right, I'm going to skip to the next slide here. Okay, so had this trader from the previous slide purchased a 2680 put. Remember, the market when we first were looking at this was around 2728, somewhere in there. So the market has basically dropped about 3 points. The S&P's fallen 3 points from where it was on the last slide. Somebody that was trading the futures would have made 150 bucks on that position. Somebody trading this option would be up about $30. Obviously 30 bucks is, I mean, we're not going to write home about that or brag about that to our friends, but I'm just trying to show you an example of kind of what the deltas would do and how somebody with a very small account and very low risk tolerance could do something like this. Obviously 30 bucks isn't a lot of money, but if you think of it this way, if you had a $10,000 account and you made $50 a day, you would more than double your account by the end of the year. So you don't have to hit home runs all the time. A little bit of money can add up. So I'm just trying to put things in perspective for you. But we'll show you what happens if this 2680 put is going for about $3 now. So it has picked up a little value, but I'll show you what's going to happen if the market goes the other way. And obviously it is going to do that from time to time. Okay, so the market is now at 2742. So this is 4 hours after the initial entry of the 2680 put. The S&P is up 14 points. Somebody that was trading the futures contract would be losing $700 per contract. Somebody that bought the 2680, the out of the money put, is only losing 80 bucks. I think we can all agree 80 bucks is a lot more tolerable and easier on the mental capacity than $700. Most day traders that were using stops would have probably been knocked out of the trade, or if they were still in the trade, they're probably under a little bit of duress and stress. Somebody that's trading long options would be, oops, I was wrong. I'm losing a few bucks, but maybe now's the time to play offense. Maybe now that person, instead of being on the sidelines and being stopped out, that person might say, well, I'm losing money on this trade, and maybe I should add on to it. Or maybe I should roll my strike price higher, or maybe I should do some sort of offensive play, because if I still think the market's going down, it's a lot better trade from 2742 than it was from 2728 or whatever the original price was. Plus, yeah, somebody mentioned plus you're still in the trade. Absolutely. This trader at this point, his option's not worth much. It really can't get a whole lot worse than that, but it can get a lot better. You're still in it. You're not knocked out. You're still in the game. And that's really the key to this. Most day trading systems generally pick the right direction in the long run. It's the short run that knocks everybody out of the markets before before they get a chance to take advantage of that. So in this situation, the market is now starting to retreat. A trader that was trading futures may have just thrown in the towel, taken a big loss, $700 or more, or they might have been stopped out on the high and unable to get back in at a reasonable price. They're probably playing head games with themselves. But an option trader, like I mentioned before, would be comfortable adding to the position or rolling the strike price higher. This trader might have taken the $80 loss and said, you know what, I want to get something a little closer to the money. I'm going to now buy the 2,700, still only having a total risk of about 150 bucks on the table, plus what you lost on the other one, the $80. But it increases the delta, puts the trader in a better position to make some money if the market turns around. Okay, so let's see what happens next. So in addition to the fact that trading is just purely a mental game, it's also a game of lasting power. Those that can last the ebbs and flows are the ones that have a much better chance of coming out ahead. You can see this mess here. A futures trader would have a really hard time staying in the trade. I mean, after all, the market broke the trend line. It popped up against the Bollinger Band. I mean, there's really probably stopped everyone out. This big long spike up, usually when a market does that and then turns around, it's running up on stops. It's hitting everybody's buy stops, forcing them out of the market. Then it comes back down. So a futures trader would have probably been watching on the sidelines, frustrated. But an option trader probably didn't miss any bathroom breaks or coffee breaks. They were probably relaxed the entire time and might have been around to catch the ride. Now, again, obviously, the option trader is not going to make nearly as much money if he's right than the futures trader would. But I think we can all agree that the outcome is probably going to be better if the trader is in a better mental situation, and that can be achieved through using options to slow things down as opposed to futures, in my opinion. So to give you an idea of how those options reacted when the market reversed as it did, the market's now trading 27.12. So the ES went from basically being up 28 points to being down $1.75. You can see that here. So we're talking a 30-point swing. A futures trader would have made or lost, roughly $700 to $1,500 on a move like that. So you could make or lose a lot of money as a futures trader. An out of the money option trader, that, like using the example that we just went over, the most risk that person had on the table was 150 bucks. And of course, you can get a lot more aggressive with it. I'm showing you the lowest risk, most risk averse way of doing it. You could have definitely bought an option closer to the money and had a lot more action. So no, I'm not trying to say that if you day trade options, you can only make $20, $30 on a trade. That's absolutely not true. I'm just showing you the slow way to do it. You can speed things up if you want. But even in this situation, this trader, with no more than 150 to 200 bucks on the table at any time as their maximum risk, could have come out $200, $300 ahead. The 2680 put is now going for $5 or $6. The 2700 put that we had bought for $3 is now going for 10 points. So that's let's say you made 6 to 7 points. You're talking $300 to 350 bucks. So it's not too bad. They can move and you can make money even though your risk is really low and limited. And again, you can speed things up. by using options that are closer to the money, or by trading in quantities. I'm a big fan of scaling in and scaling out of markets. And so this is a great way to do that. Instead of buying one or two out of the money options, buy 4 or 5, and you can add on, whatever it is that you want to do, whatever your aggression level is or your risk tolerance. But you don't have to be all in or all out. If you buy multiple contracts, you can buy a couple at a time and then sell a couple at a time. That way you're getting the best of all worlds. And again, I just want to point out that the futures price never has to get anywhere near our strike price. Remember, we were originally trading the 2680 put. And I just showed you on the previous slide that those 2680 puts had roughly tripled in value, doubled to tripled in value. And that occurred even though the futures price never got anywhere near the strike price. So don't worry about picking a strike price that you think is going to be in the money. Worry about picking an option that you think will increase in value enough to turn a profit for you. So we kind of already discussed this, but just want to reiterate. If you're looking for more profit potential, go closer to the money, trade multiple lots, leg into positions, peel them off incrementally. And we also mentioned this as well. A profit of $50 a day equates to almost $12,000 at the end of the year. So you don't have to swing for the fence. Chipping away at the markets is enough as long as you're consistent. I know, again, it's easier said than done. If it was easy, everybody would do it. But I just want to make sure everyone has the right mindset. You don't have to hit home runs every time. Someone's asking if these are European or American style options. These are European style options. So they can only be exercised at the end of the day. Somebody is asking if you can trade spreads. I believe that's the question. You could trade spreads this way. Like, for example, I don't think there'd be enough profit potential if you did like bull call spreads, like vertical spreads, but you could do something like, let's say you think the market's going to go down. You could sell a call and then buy a put, basically put together a free trade, and I think that could work. Of course, if you do that, you're getting back to unlimited risk and that sort of thing. But at the same time, it's probably a lot higher probability way of doing it than simply buying or selling a futures contract. Somebody's asking how hard is it to close out a position at the end of the day? These are very liquid almost all the time. Where you may run into a little trouble is if you're holding an option to the very end of the day on the day it expires. So if you have a Friday option and you hold it to the last 30 minutes of the day, you are going to see that thing it's going to get illiquid and it's going to be harder to trade. So don't do that. I recommend that if you're day trading options like this, pick an option that has probably 2 days to expiration, 3 days to expiration. Can trade option on the last expiration, but it's going to erode really quickly if the market doesn't move in your favor immediately. So generally speaking, you want to try to use options that have 2 or 3 days to expiration on them. So somebody's asking, why do we have to avoid expiration in the money and turn a long option into a future? You don't have to. If you have the margin to take delivery of the futures and you're perfectly fine with the risk of holding the futures contract, by all means do it. I'm just saying most people that are day trading out of the money options as a strategy probably aren't interested in taking delivery of the futures, but you certainly could. If you have the margin for it, it's no big deal. People do it all the time. So a lot of people are, I mean, obviously we are brokers. That's how we make our living. So we're here to tell you that commission isn't everything. Again, take it with a grain of salt. We're probably a little biased, but we get a lot of people. As a brokerage service, we offer a lot of service. We offer a lot of extras, hand-holding, market ideas, commentary, that sort of thing. We do charge a little more than some of the other brokers, not a lot, but I mean, an extra buck or two can go a really long way. Like I mentioned before, Most brokers don't even offer these products because they don't want to deal with the hassle of the exercising and all that kind of stuff. We offer them. And if you really think that commission is going to make a big difference, to put it into perspective, 1 point in the S&P is $50. So if you're paying an extra $1 or $2 in commission, it's not going to change whether you make or lose money. What really is going to matter is if you're trading effectively and you have a good support system. And I think that's going to go a lot further than cheap commission. And someone's mentioning you do not want to be assigned on your Friday option on Friday. That's absolutely true. So these options expire 15 minutes before the futures close, and so you don't have a lot of time to react. If you do get assigned on a Friday, there is a chance if you don't react quickly enough that you're stuck with it until Sunday night, and sometimes Sunday night markets gap up or down, and so that's not a place you want to be. So again, just as a reminder, you really do not want to hold the expiration. That's not what this strategy is doing. The strategy is just trying to play the change in option premium and catch a piece in the middle. So in conclusion, those that are looking to day trade with lower risks and less stress and do it without the limitations of being completely flat by the close to avoid full margin charges, weekly options really could be the answer. Again, there's low barriers to entry because there's no margin. You could do this sort of thing in a very small account and have very little risk. Don't worry about margin calls. You don't have to worry about premature stop outs. Where should I put my stop? That sort of thing. And best of all, you don't have to worry about runaway losses. You're never going to get caught in a runaway trade. You might lose some money if you spend $200 on an option. It might go up in smoke in a few minutes. That could happen, but you know what your risk is. You know what the worst case scenario is, and you don't have to worry about the S&P running 30, 40, 50 points away from you and causing some devastation in your account. I do also believe that this kind of trading forces traders to have a little more patience. It's not something again, you're not scalping. It's not exciting. You're not going to pick up 10, 15, 20 handles in a couple seconds like every once in a while you can in the S&P. That's not what this is all about. This is about slowing things down, reducing the noise, reducing the stress, and hopefully giving yourself a better chance to make proper decisions. Somebody's asking if you can do this for the YM, which is the mini Dow. No, I think liquidity, even the monthly options in the Dow are thin. The Dow futures are on the thin side. I would really stick to the S&P with this sort of thing. So I appreciate everybody coming out. I apologize for the audio trouble. Hopefully things ended up clearing up as we went. If you have any questions or comments or concerns, please feel free to contact us. If you visit our website, DeCarleyTrading.com, we have 30+ videos on trading. They're all free. So the idea is we want to teach people before they get involved in the markets. We want to make sure they know what they're getting into. And if you're interested in learning more about futures and options trading, please check out our books, Higher Probability Commodity Trading and A Trader's First Book on Commodities. They're both available at Amazon. That's the cheapest and best place to get them. We will have a recording of this class. I hope that the quality is up to par. We'll have to see how it goes, but we'll do our best to get the recording up and running and out to everybody so that you can review everything. If you have any questions, here's my email address and my phone number. Give us a call.